I'm going to use the examples from chapter 4 to sort of walk through the horizontal financial statements. I like how they do it in the book. I just think it's really hard to read. And I'm going to do this in Excel, and I'll post the Excel workbook along with the instructions. I think it's easier to see like this. Now, I'm not an accountant, but I've been using accounting information for 30 years, and it actually makes a lot more sense if you can keep a couple of the basic ideas down there. First of all, the balance sheet. It's split into assets and liability and equity. Assets are what you own. Liabilities and equity is where you got the money to buy the assets. Okay, it's always got a balance because what you own has to be equal to what where you got the money to buy it. The income statement stuff. Companies buy and sell assets all day long, but that doesn't flow through the income statement. It's only when they sell stuff or have transactions that it actually flows through their income. And the cash flow statement is just trying to track where the cash flows went. So let's go through this first example. This starts at page 186 of the textbook. And it's JPS, and they recorded 6 transactions, although they numbered them funny. And let's just go through here and see. This is the company starting business. All right, they acquired $15,000 of cash by issuing common stock. Okay, so cash, $15,000, because they sold shares of stock to somebody who traded them $15,000 cash in exchange for ownership of the business. Now, on my balance sheet, I add up all the assets together and I add up all the liabilities and equity. So I've added this column here, the total liabilities and equity, and the total assets column. And that's so those columns, those always have to balance. Okay, so the sum of the assets always has to balance with the sum of the liabilities and equity. All right, so selling the shares, that has nothing to do with selling stuff to our customers. It was just capitalizing the company. I'm going to save the cash flow statement for last. All right, so going to the item 2. JPS purchased some inventory. All right, we got to have stuff to sell. So what I did was bought some inventory. That's $14,000 worth of inventory. And I paid $14,000 cash for it. Notice that there is no effect on total assets here. I still have the same total amount of assets. I just shifted them from having $15,000 in cash and no other assets to now I've got $1,000 in cash. That's where the sum total over here goes. It's now $1,000 cash and $14,000 inventory. It comes up to $15,000. And it still balances because nothing happened with where I got the money from. So item 2, I just traded one asset for another. Item 3, now they split this into 2 pieces, and I dislike that, but there's a reason for it. That's because accountants keep track of everything. And it's all done in the computer, so you and I usually don't have to mess with this. But we do want you to know that they keep track of everything. And they do it in phases because, well, it's complicated. All right, so JPS recognized sales revenue. They sold some inventory for $12,000 cash. Cash goes up by $12,000 because revenue went up by $12,000. And now my balance sheet won't balance unless I also record retained earnings of $12,000. Okay, so far I sold that, assuming there were no expenses attached to it. My retained earnings is simply the amount of liabilities and equity that matches up to the total assets. All right, but the second part of here, they recognize $8,000 cost of goods sold. Okay, $8,000 cost of goods sold is an expense. And the cost of goods sold means that inventory had to go down by $8,000 to keep the balance sheet balancing. Retained earnings goes down by $8,000. Okay, so really if I had added these two lines together, which is how you and I would normally do it, we can see that we still have now $19,000 of total assets. We started with 15 in cash and then converted some of the cash to inventory and then took some of that inventory and sold it off. And when we sold it off, we converted it back into cash. So that's that accounting cycle going on and on. The balance sheet still balances. Our total net income is $4,000, which is also the increase in the retained earnings. Okay, so item number 4, JPS paid $1,000 cash, selling, general, and admin. Okay, assets go down by $1,000 because we had to go pay people their paychecks, basically. And that's just a expense over here. And retained earnings goes down to keep the balance sheet balancing. All right, so now I don't have 4,000 of retained earnings. I only have 3,000 because I had to pay my employees. And then this last item, they paid $5,500 in cash to purchase some land. Okay, that's $5,500 in cash. So we just took it out of the cash account and put it into the land account. Okay, hasn't got anything to do with liabilities and equity because we were just trading the assets. All right, and we weren't selling stuff to anybody, so that didn't really, nothing happened over there. All right, so we can see now that at the end of the year, total assets are $18,000. The liabilities and equity are $18,000. The original $15,000 I started with, plus the $3,000 net income I earned from selling crap to my customers. Sales were $12,000. Total expenses were $9,000. $3,000 there. Let's get to the cash flow statement because this is the last part. Anything that happened over here happens over here. Cash flow statement is just measuring what happened over here in cash flow. Okay. So I've got to account for all of these. I don't have to account for this inventory hootenanny. That's because this inventory I sold, the cash flow from that inventory happened up here when I bought the inventory. All right, so the cash flow statement, then we want to identify which section of the income statement or the cash flow statement it goes into. The cash flow statement, operating activities, investing activities, and financing activities. Operating activities are things that flow through the income statement and changes in the working capital accounts, accounts receivable, and inventory, accounts payable, and notes payable. None of which we used in this first year. All right, so operating activities are anything that occurred in the income statement and anything that occurred in accounts receivable or inventory, anything that occurred in accounts payable or notes payable. You'll get better at this with more practice. All right, so the $15,000 that we got from cash was from financing activities. That's we sold some shares of stock. All right, so common stock would be financing activities. There are going to be some others as we go along. The $14,000 of inventory we bought is an operating activity. The $12,000 of cash from revenue, that's an operating activity. There's nothing in there. The $1,000 that we spent from SG&A expenses is an operating activity. And the $5,500 that we paid for land, an investing activity. All right, so we've classified investing activities are long-term assets. The only one we're showing is land. All right, so Now we have an income statement, revenue 12,000, expenses 9,000, net income 3,000. We got a balance sheet with assets that total $18,000, 6,500 cash, 6,000 in inventory, 5,500 in land. That's the assets or things that JPS owns. Where'd they get the money to buy the stuff? They sold $15,000 worth of common stock and they earned $3,000 of net retained earnings. All right, balance sheet balances, all is good with the world.